Hello and welcome to the session in which we would look at the operating cash flow, sales volume, and break-even. If you don't know how to calculate the break-even, the basic break-even formula that we looked at in the prior session, please go ahead and review the prior session. Otherwise, what we learned in the prior session, that we can say that the break-even, the accounting break-even, equal to fixed cost, then they add depreciation, but I said depreciation is the same thing as fixed cost divided by the selling price. It was P minus V. P minus V. This is the selling price minus the variable cost, which is what I call this. I call this CM, which is equal to the contribution margin. So you want to make sure you know this much at least before you start this session. Also, hopefully you know how to calculate the operating cash flow, which we've been working with since chapter 2. So let's go ahead and start this session. So accounting break-even, which we looked at in the prior session, accounting break-even is one tool that's useful for project analysis. Ultimately, however, we're more interested not in accounting, in cash flow. Okay, because remember, we talked about cash flow in this session. So far, for example, if sales volume is critical variable, then we need to know more about the relationship between sales volume and cash flow. Basically, what we're doing is going from sales to cash. So we want to know on a cash basis how much cash we're bringing in, because our analysis is called DCF, discounted cash flow, not discounted accounting, discounted cash flow. Our goal in this section, and basically we looked at this before in one way or another, is to illustrate the relationship between operating cash and sales volume. We also discussed some other break-even measures. To simplify matter, we will ignore the effect of taxes. We'll start by looking at the relationship between accounting break-even and cash flow. Okay, so we know both. We know accounting break-even, how it works, and we know how cash flow works. So let's go ahead and get started. So now we know that how to find accounting break-even. It's natural to wonder what happened with cash flow. To illustrate, suppose that this sailboat corporation is considering whether to launch its new Margot class sailboat. The selling price will be $40,000 per boat. So this is the selling price. The variable cost will be about half. About half is $20,000. And fixed cost will be $500,000. Well, if I take 40,000 minus 20,000, that's going to give me my variable cost of 20,000. Then per unit, this is 20,000 per unit. So if I take 20,000, this is my, what we call this is CM. This is called CM, contribution margin. If I take my fixed cost, which is $500,000, divided by 20,000, my CM, what I learned in the prior session. So if I take $500,000 divided by 20,000, before I go into any further, I know I need to sell 25 units to break even from an accounting perspective. The total investment needed for this project is $3.5 million. The amount will be depreciated straight line to zero, which is going to be fully depreciated over 5 years. The equipment will have a salvage value of zero, so we can't sell it for anything, and there is no working capital needed. And we have a 20% required rate of return. Based on market survey, we project that total sales for 5 years will be 425 boats, or about 85 boats per year, ignoring taxes, should we undertake this project. Okay. Before we begin, the operating cash flow at 85 boats per year is the following. So now we need to find out, is the operating cash flow at 85 boats? That's easy to calculate. Well, what's the operating cash flow? It's equal to EBIT plus depreciation minus taxes. What is EBIT? Earnings before interest and taxes. It's sales minus variable cost minus fixed cost minus depreciation. Okay. Now, then we're going to add back depreciation because it's a non-cash flow minus zero. Now, we have 85 boats times 20,000. Where is that 20,000 coming from? 20,000 is the selling price minus the variable cost, okay, minus $500,000. So basically, what is 85 times 85 boats times 20,000? 85 boats times $20,000 is 1.7 million minus $500,000 in fixed cost will give me 1.2 million. Okay, so this is my operating cash flow per year, All what I have to do now, since I know my operating cash flow per year, I can discount the operating cash flow with the annuity factor of 2.9906, or using a financial calculator. My outflow is 3.5 million. The present value of 1.2 million multiplied by 2.9906 is 3,585,000. The project has a positive NPV. In the absence of additional information, the project should be launched. Because why? NPV equal to 0. So, calculating the break-even level. To begin looking a little closer at this project, we might ask a series of questions. For example, how many new boats does the company need to sell for the project to break even on an accounting basis? If the company does not break even, what will be the annual cash flow from the project? What will be the return on the investment in this case? Okay. Before the fixed cost and depreciation are considered, let me generate $20 contribution margin per boat. So every boat they sell, they generate $20,000. Now the depreciation, which I ignored in the prior calculation when I did it the first time. So notice here, let me go back because I don't want to confuse you here saying where did that number came from. When I calculated the break even here, oops, let me go back there. When I calculated the break even in this example, I did not include here 700,000 of depreciation. I did not include that. Just want to let you know, just in case you're wondering, because this is going to appear with us again. Okay. Depreciation is $700,000 per year. Fixed cost and depreciation total of 1.2 million. Now I can do it again. Now fixed cost plus depreciation becomes 1.7 million divided by the contribution margin. So I need to sell actually, and by adding 700,000 of depreciation, I need to sell 60 boats to break even on an accounting basis. Once again, how did I do this? You remember I had fixed cost initially of $500,000. Then I'm going to add 700,000 of depreciation, and each boat contribute 20,000 to my profit. Therefore I need 60 boats. I need 60 boats to sell to break even. This is 25 boats less than the projected sales, which is good because I'm projecting 85. So assuming that I am confident about my projection, within 15 boats, then I'm in good shape because I think I can sell 85, but I could be wrong 15. So I might, worst case situation, I might sell 70, worst case situation, and there's a chance I might sell 100. So that's another projection. So if my break even is 60, I think I'm going to be in good shape. Okay. To calculate the company's cash flow in this case, we note that if 60 boats are sold, net income will be exactly 0. Recalling from the previous chapter that operating cash flow for a project can be written as net income plus depreciation. This is the bottom-up definition that we looked at in the prior chapter. We can say that the operating cash flow equal to the depreciation or $700,000. The internal rate of return is exactly 0 because we're breaking even. We're not making any profit. Okay. Something similar to break even is the payback. Okay. And what is the payback? Is how fast am I going to recoup my investment? As our example illustrates, whenever a project breaks even on an accounting basis, the cash flow for that period will equal to the depreciation. Of course, the result makes perfect accounting sense. For example, suppose we invest 100,000 in 5 years. The depreciation is straight line to a zero salvage, or $20,000 per year, because it's a 100,000 asset divided it by 5 years. It's 20,000 per year, and by 5 years it's fully depreciated. So the sum of the cash flow for the life of this project is equal to 100,000. Basically, you're gonna get your money back because the $20,000 is not really a cash flow. What this shows is that the project payback period is exactly equal to the life of the project, breaks even every period. Similarly, a project that does better than break even has a payback that's shorter. Obviously, if the project does better than the break even, it's going to have a shorter than 5 years, mathematically speaking, of course. The bad news is that a project that just breaks even on an accounting basis, has a negative NPV and a 0 return. For our sailboat project, the fact that the company will almost surely break even on an accounting basis is partially comforting because it means that the firm's downside risk is limited, but we still don't know if the project will be profitable. So we need to do more work. Okay. So what we're going to look at now is sales volume and operating cash flow. Now, sales volume and an operating cash flow. This is going to give us a better idea. At this point, we can generalize our example and introduce some other break-even measure. From our discussion in the previous section, we know that ignoring taxes, a project operating cash flow, OCF, can be written simply as EBIT plus depreciation. So let's take a look at this formula again. Operating cash flow equal to the selling price minus the contribution margin, minus the variable cost, which is, this is the CM, contribution margin, times the quantity minus the fixed cost minus depreciation plus depreciation. Why do we add back depreciation? Why do we minus it then add it back? Because this is a non-cash outflow. Okay, so basically sales minus variable cost, which is contribution margin, times quantity minus fixed cost. That's what it boils down to. From the sailboat project, the general relationship between operating cash flow and sales volume is what? It's 40,000 minus 20,000, so the contribution margin equal to 20, times the quantity minus 500, minus 500. So basically what it boils down to, negative 500 plus 20 times quantity is the operating cash flow. Okay, so what this tells us is that the relationship between operating cash flow and sales volume is given by a straight line with a slope of 20 and a y-intercept. Y-intercept means fixed cost. Fixed cost. Okay, so basically what we can say, remember the total cost formula. So remember the total cost formula. What does it say? Total cost equal to fixed cost plus variable cost. Here the fixed cost is 500 plus the variable cost. The variable cost is 20 times Q. Okay, 20 times Q. Okay, let's kind of take this formula and project it at several output level. Let's do it again here to see how it works. Once again, total cost equal to fixed cost equal to fixed cost plus variable cost. So fixed cost is 500 plus 20,000 or 20 times Q. So starting with the first plug, if we have 0, if 0 is the quantity, then we still have to come up, the cash flow is negative 500. If we sell 15, so what's going to happen? 500 plus 20 times 15. 20 times 15 equal to 300. We still at a loss because 500 fixed cost isn't going to be enough, so we're going to be negative 200. Again, we'll do the same thing for 30. For 30, so negative 500, basically the fixed cost plus the contribution is going to be 20 times 30, which is going to be 600 minus 500 plus 600 equal plus 100. Therefore, we have an operating cash flow of 150. We have an operating cash flow of 500. These points are plotted in figure 11-5, where we have indicated 3 different break-even points. So this is what's going to happen now. Okay, now we're going to look at cash flow accounting and financial break-even. So notice we have many break-even depending on how you define the break-even point. On a cash break-even point, it was 25 units. Okay, notice here we have 3 break-even points. We have the cash break-even point. Let's do this. We have the cash break-even point. we have the accounting break-even point, accounting break-even, cash break-even, and we have the financial break-even point, which is at 84 boats. So depending which break-even point you are looking at, is it cash, is it accounting, so on and so forth. But let's take a look at the financial break-even point. We haven't looked at that yet. So we know from the preceding discussion the relationship between operating cash flow and sales volume. Operating cash flow equal to the selling price minus the variable cost times the quantity minus the fixed cost. If we rearrange this, we can solve for Q. So Q, basically rearranging this to solve for Q, equal to fixed cost plus the operating cash flow divided by the selling price minus the variable cost. Okay, so if we find Q, this tells us that the sales volume necessary to achieve any given operating cash flow, so the result is more general than accounting break-even. We use this to find the various break-even point in figure 11-5. So if we take the numbers that we have and we plug it into the formula, and we find out that the break-even point is 84, the financial break-even point, So looking at figure 11-5, suppose operating cash flow is equal to the depreciation. Recall that this substitution corresponds to our break-even point on an accounting basis. To find sales volume, we substitute 700 for the amount of operating cash flow, because remember what we're saying here, 700 is equal to the depreciation, which is equal to the operating cash flow. So 500 plus 700 divided by 20 equal to 60. So this is the same as exactly as we had before, accounting break-even. Okay, cash break-even equal to fixed cost divided by the contribution margin without adding any depreciation. So fixed cost equal to 500. So basically the cash break-even you take out. So let me just have them together. Maybe it'll be easier to see. So look, the difference between accounting and cash, accounting break-even and cash break-even, there you go. If we look at the difference between the two, the accounting break-even, you'll take fixed cost plus operating cash flow. We're assuming this is equal to the depreciation. So notice we have 1.2 million in the numerator, 20,000 in the denominator. This is for accounting. For break-even, we don't include depreciation. There's no depreciation. Therefore, it's only fixed cost divided by selling minus contribution margin, which equal to 25 votes. So depending on how we which break-even we are calculating. Okay. The last case we consider is the financial break-even. So let's take a look at the financial break-even. The financial break-even, to the financial manager, this is the most interesting case. What we do is first determine what operating cash flow has to be for NPV equal to 0. Then we use this amount to determine the sales volume. To illustrate, so this company required a 20% rate of return on its 3.5 million investments. How many sailboat does this company have to sell the break-even once we account for the 20% per year opportunity cost? Because remember, we have to earn 20%. Okay, so this is the financial break-even. So the sailboat project has 5-year life. The project has 0 NPV when the present value of the operating cash flow equal to 3.5 million, obviously. Because the cash flow is the same every year, we can solve for the unknown by viewing it as an ordinary annuity. The 5-year annuity factor for 20% is 2.9906. So basically what we're doing is we're looking for the operating cash flow. So we're basically looking at what is the operating cash flow, year 1, 2, 3, 4, and 5. So what's the operating cash flow? What's the operating cash flow each year? Again, using the, it's an annuity. So sum operating cash flow times the annuity factor, period equal to 5, interest rate equal to 20%, that's 2.9906. Then we can solve for OCF. Operating cash flow should be 1,170,000 because we're going to generate 1,170,000, 1,170,000, 1,170,000, 1,170,000. Then if we discount those to to the present value at 20%, which is annuity, it's going to give us 3.5 million. Okay, so we need an operating cash flow of 1,170,000 each year to break even. Now we need to plug this operating cash flow into the equation for sales. Remember, we're not looking for the operating cash flow. We want to know from the operating cash flow how many units we need to sell. Well, it's going to be 500,000, which is the fixed cost, plus the operating cash flow. So we need to recover both, divided by contribution margin. Think of this as a profit. So simply put, to calculate the financial break-even, we'll take fixed cost, if you want to look at it that way, plus the profit. But here the profit has to be operating cash flow divided by CM. So this is the formula for the financial break-even. So it's your fixed cost plus your operating cash flow, which is calculated by finding the operating cash flow divided by the contribution margin. Okay, so we need to sell approximately 84 boats. Now this is not good news, because remember, we project to sell how many boats? 85. And what we're saying is 84 is the break-even financial point. So so if we make any mistakes, especially if we sell less, financially we're not going to break even. Okay, so this is going to tell us, gives us 3 break-even points: a cash break-even point, an accounting break-even point, and a financial break-even point. Overall, it seems unlikely that the sale project would fail to break even on an accounting basis. However, there appears to be a good chance that the MPV is negative, to illustrate the danger in looking just at accounting break-even. So accounting break-even is not really relevant. What we want to know is operating cash flow, because accounting break-even looked good, because it said you just need to sell 60 boats and you can break even. But it's not a good idea, because when we look at the operating cash flow from a cash flow perspective, we're right there. We're at the projection level to break even. So that's not good. So if we're thinking we can sell 85 and we can only break even on a financial basis, then that's not a good idea. Okay, so this is basically the end of this session. The next topic we're going to look at is, in this session, is operating leverage, which is going to rely on variable and fixed cost. If you have any questions, by all means, email me.